Hi, Patrick Russell, EA, with today's Caliente topic. Does an S corporate officer have to pay themselves with a paycheck? This is a classic topic, an oldie but goodie. I've had this discussion ever since taking over the family practice back in 2005. And the simplest answer to the basic question is yes. Yes, you do. But the heart of the client's question is a little bit more nuanced than that. Pat, how much of what I take out of the company can I get away with not calling a paycheck? Let's start with a few basics. When I say corporate officers, I mean the shareholders, the stockholders, and stakeholders in the S corporation, the owners. Yep, they all mean the same thing. So owners that also perform duties and services for said S corporation, right? People that not only own, but put the time in. AKA statutory employees, meaning they are employees because the law says they are. And by the law, I mean CFR 26, section 31.3121-1, paragraph D, subparagraph B. This provision plainly states corporate owners are employees of the corporation. Let's briefly go back in time. 1937. FDR signs into law what true historians know as the Federal Insurance Contribution Act, but what the rest of us know as Social Security and Medicare, aka those payroll tax withholdings you see on your pay stub and silently swear to yourself, that better be there when I retire. Good luck to all of us on that one. The next word you want to know is distributions. When I say distributions, I mean the money paid out from the corporate bank account to the officer's personal account. So now, let's set the table for the perfect conditions. Meaning, when is it absolutely clear that an officer must receive a paycheck? When you answer yes to these three questions. 1. Is the corporation generating revenue? Yes, it is. 2. Am I taking distributions from the corporate accounts? Yes, I am. 3. Are you the only key employee? What? A key employee is the fancy term for a person owning a material stake in the company and having decision-making powers. So if you're the only key employee, then my friend, you need a paycheck. The logic being someone has to be the captain of the boat. The next question usually is, all right, Pat, how much of what I take from the company as distributions do I have to call a paycheck? Here is where I should clarify why anybody cares. The payroll taxes. Payroll taxes are set at a rate of 15.3%, which adds $1,530 on every $10,000 worth of wages you pay yourself. It's why S Corp owners do their very best to justify a low salary. So how much can you get away with, you ask? This is where the answer changes from an emphatic yes you do to a more trepid it depends. And the reason why it depends is because of, yet again, loopholes. Loopholes exist all over this issue. The War of Words began in 1959 with the publication of an IRS Revenue Ruling, IRS Revenue Ruling 59-221. It held that a shareholder's undistributed share of S corporate income is not treated as self-employment income. What? All I said was this: any distributions taken from the company profits, aka the draws, are not charged with Social Security and Medicare taxes. A much cheaper way of pulling money out of the S Corp. Well, what do you think happened next? Abuse, baby! And a lot of it. S corporate owners would pay themselves next to nothing and would instead take the cheaper draws from the S Corp profits. Well, the IRS began firing back in 1974, releasing yet another revenue ruling. The IRS Revenue Ruling 74-44. This one stated that an S corporation must pay an S corp officer a reasonable salary for the services performed. But reasonable to who? Or is it to whom? Damn it. You get the point. It's a broad definition, one that has been hotly contested by overzealous corporate owners and the equally obstinate IRS auditing department in tax court cases happening to this very day. And through the rubble, a working standard has emerged. Along with tax court decisions, agents and practitioners have crafted arguments based on information from the Bureau of Labor Statistics, the Risk Management Association, the RMA, and brand new things like the Reasonable Compensation Report, the RCR. All of these resources help create a working rule of thumb. This is the answer I give confidently to all my S Corp clients, even without knowing all of the particulars. And that is the 1/3 split. The 1/3 split concept. 1/3 should be paid out to officer salary, 1/3 should be paid out to reimburse expenses, and 1/3 should be paid out as the draws off corporate profits. What do I mean by reimbursed expenses, you ask? Too much for one Caliente topic. But simply put, an officer can run a monthly reimbursement plan for personal costs used for the business, including the use of the home. More on that in another Caliente topic. Now, diving deeper into the 1/3 concept. The 1/3 paid out as officer salary doesn't have to include just paycheck. You can push down the costlier wage factor even further by including special, non-taxable fringe benefits, items like the S Corp officer's health insurance, as well as any HSA contributions made by the S Corp. Both will be write-offs to the S Corp and at the same time increase the officer's box 1 wage amount without actually adding any of those payroll taxes we're trying to avoid. Last word on this. The audit risk scale in this issue is pretty simple. You eliminate any risk by paying yourself 100% of the S Corp profits as a paycheck, or you can pay yourself a zero salary and just wait for that audit letter to arrive. The trick is finding the happy medium. Also keep in mind that this rule of thumb I'm suggesting should only be applied to small S Corps with 1 to 3 owners tops. For larger S Corps with employees, especially with middle management, a much closer evaluation of the officer's involvement in the operations is needed. And should you need that type of consultation, feel free to email me at help@mmtaxman.com. I will be more than happy to evaluate and advise you for your specific situation. That's today's Caliente topic. I thank you so much for watching. I look forward to seeing you soon. Take care.